Alrighty, welcome back to the Smart Investing Show, and this is where we kick up the second half with financial planning. And for that, we are joined by Harrison Johnson, a CFP with Wilsey Asset Management. Harrison, glad you're here.
Good to be here, always.
And I think when you're done, people are going to say, I'm glad I heard that, because you're talking about taking advantage of itemized deductions before December 31st. You realize there's only, 11 days left? How many days left?
Well, I know. Christmas is a week, next
Yeah,
week.
well, today's today is the 20th. So you got, about 11 days.
Yeah. So there's still time. So that's why we're
All right,
talking about
what
it
you
today.
got?
So this year with the tax law that passed earlier in July, itemized deductions are going to be changing. There's still people out there that are not going to be able to itemize because the standard deduction is large and it got increased as well. But since there's the repeal of the $10,000 SALT deduction limit, which applies to state income taxes and property taxes, more people, especially in places like California, are going to be able to itemize. And so individuals are cash basis taxpayers, so they are able to deduct things that they pay when they spend the money as opposed to when it's actually due. So for example, property taxes are due December and April for this fiscal year. However, if you make that April payment before the end of the year, that means you can deduct it this year on your taxes. State income taxes is another one. So if you make estimated tax payments, the fourth state tax payment is due January 15th. But if you make it before the end of the year, that means you can deduct it this year with the other deductions. Another thing is if you are, on payroll and you have taxes withheld from your paycheck, you can increase your withholdings if you need to. And any withholdings that are withheld from your paycheck are deductible this year as opposed to next year. Another thing with your mortgage interest, mortgage payments are due on the first of the month. And then they're, as long as you pay it by the 15th of the month or the 16th of the month, there's no interest or problems with that. So this next January payment due January 1st, if you make it before the end of the year, the interest that's associated with that payment will then be deductible this year. So it's a way to take expenses that really aren't due until next year, pay them this year, and then that might allow you to itemize because now you have enough deductions to get above the standard deduction. Or if you are already able to itemize, this increases that deduction and accelerates that tax savings 1 year sooner.
Now, don't you want to think about your situation for income? Because say you have really low income this year and high income next year, do you want to do this? Or
then
no?
you might want to defer it. So that's a very good point. You have to look at what tax bracket are you in this year, what tax bracket are you in next year. If you're in the same tax bracket, then it probably makes sense to accelerate it. Dollars today are more valuable than dollars tomorrow or next year in that case. So you're better off making those payments and getting the tax payment sooner. But you're right. If you expect income to be higher next year, for example, then maybe what you would want to do is defer those payments to next year, and then the payments that you have next year, accelerate those ones, 12 months from now and pay those at the end of next year. And that way you're kind of clumping all of those deductions into 2026. So yeah, you want to look at what brackets you're in and kind of where you can make payments to get that deduction. Charitable deductions is another one. Next year in 2026, there's a change to how much you're able to deduct when you make itemized charitable donations. So that's something where you might want to make extra donations this year, if that's something that you do, because they're more valuable this year because they're not subject to AGI limit next year.
Right.
And I almost think this is really helpful for somebody maybe that's like retiring
next
year.
A big
that
part of it, yeah.
Huge benefit.
Yeah, if you had a lot of W-2 income this year, maybe you got severance pay or something because you retired this year and your income is high, and next year it's going to be lower because you're on Social Security and you're choosing how much of your retirement accounts you're able to withdraw or you want to draw, and you're going to be in a lower tax bracket. This might be, your last high tax year before you go into low taxes. And so if you can accelerate some of those deductions, write them off this year, could save you a few $1,000s since they're not going to be worth as much next year.
Another concern too, and I know it's going to happen. You say, Brent, you probably don't qualify. Income levels. You said there's no more SALT limits. So what about the income?
So good that
limits?
you bring it up, because right now it used to be $10,000. Right now,
But I'm talking about the income that you receive, your yearly income.
Yes, your income determines how much of this you can deduct.
Right.
So the limit was $10,000. Now it's as high as $40,000, but that has an AGI phase out between $500,000 and $600,000. So if
Okay.
your income is less than $500,000, then you can deduct up to $40,000 of state income and property taxes. So that's another thing to keep an eye on is if you're under that income level, but if you've already paid state income taxes and property taxes that are $40,000, then making extra payments this year won't help you because you can only deduct 40 grand of those. But to your point, Brent, at $500,000 or below, up to 40 grand, and then as your income exceeds 500 and goes up to 600,000, that $40,000 cap then phases down to $10,000.
Phases out.
Yes,
Phases down.
Phases
and
down.
Phases out.
Yeah, yeah.
No, that's all I got. I mean,
all you got?
yeah, just love taxes.
Well, I hate them personally. So
Oh, I did too. And it's so important you bring this up because, people like they hear just part of it. Oh, great, I'm going to, accelerate my deductions. And all of a sudden, your income's $700,000. Sorry, you got
Didn't
nothing
do
to do with it.
anything. Yeah.
didn't do anything.
Yeah.
Another reason why I've kind of been having this conversation with people lately is, maybe this was a year where you had extra capital gains. And so those capital gains are triggering net investment income tax, or, if their income's really high, maybe that's triggering, pushing you into a higher capital gain tax bracket. So you want extra deductions. So maybe it's not ordinary income that you're worried about. Maybe it's other investment income. So making, these payments in December as opposed to January or April or whatever it is, gets those deductions sooner, and then it offsets maybe some of that higher investment income you might have had because the stock market's been doing pretty
So that
well.
could help with like Irma and
Right.
everything
Irma
else
too, yeah.
yeah.
Well, doesn't help with Irma now that I think about it, because this is an itemized deduction. Itemized deductions reduce taxable income. Irma is based on adjusted gross, so that's based on the total. So it purely influences your federal income tax liability. But, if you're in a higher tax bracket, people are always looking for extra deductions. So
And I got a quick question. I mean, you're a fee-based planner. You take care of the stuff for people that can call you up and you say, yes, you can do this, you can't do that. Because I think some people, their immediate response is, I'm going to call my CPA. But if they've got a good fee-based financial planner, call you first.
I mean, this is stuff that I'm always trying to be proactive. Some CPAs are probably also looking at this type of thing, but other ones might be, you might not be talking to them until April when you pay your taxes. And so, but at that point, it's too late because this is something that you want to do before the end of the year. So, with your CPA, you might be talking to them February, March, April as you get your 1099s and your W-2s and everything. But if you can have this type of conversation, we could pretty quickly look at what your income looks like, what things you should or should not do. If, it's the end of the year and you're also taking required distributions or doing Roth conversions, what is that tax impact going to be? Do you want to have extra tax withholdings on that? Like if you're doing an IRA withdrawal because you have to take an RMD, maybe we want to have a larger amount of that withdrawal withheld for state taxes, because that means that on your 1099, that's going to show state withholdings that are deductible when you file your taxes. So all of those things, we look at, and you need to have it done before the end of the year.
And I point this out because I want people to understand the difference between a fee-based planner like yourself and somebody that calls themselves a financial planner and turn around and sells you life insurance, annuity, or mutual funds, whatever it may be. I mean, a true fee-based financial planner knows the tax situation. These other guys that are, I'm going to say salespeople, they're not even going to address this. They don't even know what you're talking about.
Yeah. I mean, I don't have to sell anything because there's so much to know about with this type of stuff, and there's so much value that can be added by understanding this. I like learning about it. A lot of people don't, but I think it's interesting. So,
well, we like numbers. I mean, we're a weird group because we like numbers, we like finance, you like the taxes, and it's like that's why we have a lot of clients, because they like coming and talk to us. So, Harrison, thank you very much. We appreciate the time, and you have a good day.
Thanks, guys.
All righty. Again, that's Harrison Johnson. He's a CFP. If you want to contact him, you have questions about a financial plan, questions about your taxes, maybe the guy you're talking to or woman you're talking to is not getting back to you, gives you no help at all, give him a call at the office. Harrison, give him a call at the office, 858-224-0004. Again, that's 858-224-0004.